Why do the smartest traders keep losing? Not the beginners, not the people who just downloaded a trading app last week. The smart ones, the ones who read every book, studied every chart, stayed up until 3 in the morning backtesting strategies that looked perfect on paper. Why do they keep blowing up their accounts? And more importantly, why does a trader with an average IQ, no formal education in finance, and a simple system sometimes outperform them consistently, month after month? This is not a question about skill. This is not a question about strategy. This is a question about the human mind. And the answer is going to make you deeply uncomfortable because it's going to reveal something about yourself that you may not want to see. Welcome. And if you've ever felt like you're too smart for your own good in the markets, this video was made for you. Let's start with a story. There was a trader, let's call him Marcus. Marcus had an engineering degree, an MBA, and years of experience analyzing complex systems. He could read a balance sheet faster than most people read a menu. He had built trading models that, on paper, had a win rate above 60%. He was, by every measurable standard, smart. And in his first 2 years of live trading, he lost everything, twice. Not because his models were wrong, not because the market was unfair, but because every single time the market moved against him, his brilliant mind found a reason, a perfectly logical, intellectually airtight reason to ignore his stop loss, to hold just a little longer, to average down on a losing position, to convince himself that the market was wrong and he was right. His intelligence wasn't saving him, it was destroying him. And this exact pattern is what I'm calling the intelligence trap. And today, we're going to break it down completely. Point 1. Smart people are better at justifying bad decisions. Here's the first thing you need to understand. Intelligence in trading is a double-edged sword, and most people only see one side of it. The side everyone celebrates is obvious. Smart traders can analyze data faster. They can recognize patterns. They can build sophisticated systems. They understand risk-reward ratios, volatility structures, and macroeconomic forces in ways that most people can't. But there's another side, a darker side, and it's called motivated reasoning. Motivated reasoning is a cognitive bias where your brain uses its intelligence not to find the truth, but to justify what you already want to believe. Think about that. Your brain is not neutral. Your brain is an emotion-driven machine that uses logic as a tool to defend emotional decisions, and the smarter you are, the better your brain is at doing this. Let me say that again because this is crucial. The smarter you are, the better you are at rationalizing your emotional decisions. A less intelligent trader sees a losing trade and thinks, I don't know what's happening. I better just follow my stop and get out. An intelligent trader sees a losing trade and thinks, wait, let me look at the macro picture. Let me check the fundamentals. Let me consider the seasonal trends, the Fed announcement next week, the recent institutional flow data. And by the time they finish their analysis, the position is down another 15%. This is not stupidity wearing a smart mask. This is intelligence being hijacked by ego. And it happens to brilliant people every single day in the markets. There's a famous study that looked at political beliefs and intelligence. Researchers found that smarter people were actually worse at evaluating evidence objectively when the evidence challenged their existing beliefs. They used their intelligence to poke holes in opposing arguments, not to genuinely examine their own position. Trading works exactly the same way. When you're in a losing trade, your ego doesn't want to be wrong. Your brain, your powerful, analytical, pattern-recognizing brain, immediately gets recruited to find reasons why you're actually right. It starts scanning for confirming data. It builds a case. It constructs a narrative. And it does it so convincingly that you believe it completely. This is why the smartest traders are often the most dangerous to themselves, because their narratives are better, more detailed, more convincing, more sophisticated. They don't just tell themselves the trade will come back, they tell themselves a story involving central bank policy, order flow dynamics, and the historical behavior of the asset during this particular macro cycle. And that story feels true. But it's still just a story, built to protect an ego that doesn't want to admit it was wrong. The solution is not to become less intelligent. The solution is to build systems that your intelligence cannot override in the heat of the moment. Hard stop losses, automated exits, pre-committed rules written in advance when you're calm and clear that you are not allowed to negotiate with when you're in a trade, because the rule version of you is smarter than the in-trade version of you, always. Point 2. The curse of pattern recognition. Smart traders are obsessed with patterns, and rightfully so. Markets do have patterns. There are recurring structures in price behavior, in volume, in sentiment cycles. Identifying these patterns is a real edge, but there's a problem, and the problem is this: your brain doesn't just recognize real patterns, it invents them. Psychologists call this pareidolia, the human tendency to see meaningful patterns in random noise. It's why we see faces in clouds, why we hear words in static, why we find meaning in coincidence. The human brain is a pattern recognition machine that is always running, always searching, always connecting dots, even when there are no dots to connect. And in the markets, this tendency doesn't go away just because you're smart. In fact, smart traders experience it more intensely because they have more data to work with. Here's what this looks like in practice. A smart trader studies a specific candlestick pattern. Let's say a bearish engulfing candle near a key resistance level. They see it work. Then they see it work again and again. Their brain locks onto it. It becomes a signal. It becomes truth. They start seeing it everywhere, in time frames where it barely applies, in markets where the structure is completely different. But because their brain has already decided it's a real pattern, they keep trading it. This is called illusory correlation, and it's a well-documented psychological phenomenon where we perceive a strong relationship between two variables, even when the actual statistical relationship is weak or non-existent. Smart traders are particularly vulnerable to this because they're good at building frameworks. They're good at connecting ideas. They take a pattern, wrap it in theory, give it a name, and suddenly it feels more real than it actually is. They've intellectualized the illusion. There's another layer to this. Pattern recognition in intelligent people comes with something called apophenia, a broad tendency to find meaning in unrelated things. Researchers have noted that this trait is common in highly creative and highly analytical people alike. It's part of what makes them innovative. But in a probabilistic environment like the markets, this can lead to serious overconfidence. Because here's the truth about markets that no intelligent person wants to accept. Markets are partially random, not completely random. There are real patterns, real edges, real predictable behaviors, but there is always a significant component of randomness. And that randomness doesn't care how intelligent you are. It doesn't care how sophisticated your framework is. It doesn't care that you spent 3 months building this model. It just moves. And when a smart trader encounters a losing streak, even when their system has a genuine edge, their brain immediately starts searching for the pattern within the losing streak. What did these losing trades have in common? What was different? What needs to change? And sometimes the honest answer is nothing. It was just variance. It was just the random component of a probabilistic system expressing itself. But a smart brain can't accept that answer. A smart brain needs a reason, so it finds one, and it starts tweaking the system, over-optimizing, adding conditions, removing rules, curve-fitting perfectly good systems until they no longer work. This is called overfitting, and it's one of the leading causes of system destruction in quantitatively sophisticated traders. They're not dumb, they're too smart to tolerate randomness, and that intolerance breaks their edge. Point 3. The confidence paradox. Let me ask you something. Have you ever been so sure about a trade that you sized up more than your normal position? Maybe twice your normal position because this one just felt different. This one you had done the work on. This one you could feel. And then it didn't work. That experience, that overconfidence followed by unexpected loss, is one of the most psychologically damaging things that can happen to a trader, not just financially, emotionally, because it doesn't just cost you money, it challenges your identity. Smart traders have a particular vulnerability here. It's called the Dunning-Kruger effect, but in reverse. You've probably heard of Dunning-Kruger in the context of incompetent people overestimating their ability, but there's a less discussed dimension of this phenomenon that applies at the opposite end of the spectrum. When genuinely competent, intelligent people accumulate knowledge and experience, they can develop a form of overconfidence that's much harder to detect because it's built on real competence. It's not the naive confidence of a beginner, it's sophisticated confidence, evidence-based confidence, and that makes it more dangerous. Because sophisticated confidence doesn't feel like arrogance, it feels like earned certainty. It feels like the reward for all the hard work and study you've done, and the markets punish it just as hard. Here's what happens in the brain of an intelligent trader who's been studying markets for years. They have accumulated a vast library of patterns, scenarios, outcomes, analogies. When they look at a chart, their brain is simultaneously cross-referencing hundreds of historical cases. This process feels like insight. It feels like deep analysis. It feels like an edge. But cognitive science has a term for this: expert intuition, and expert intuition is only reliable in environments that are regular, predictable, and provide fast, clear feedback. Chess is a good environment for expert intuition. Surgery has elements that support it. Medicine in some domains. Markets? Markets are what researchers call a wicked learning environment. The feedback is delayed, noisy, and often misleading. You can be right for the wrong reasons and wrong for the right reasons, repeatedly, in ways that corrupt the pattern recognition feedback loop that builds real expertise. So, the intelligent trader builds confidence, real, data-backed, experience-grounded confidence. But that confidence is partly built on a corrupted feedback loop. And when they size up their position on a trade they're highly confident in, they're not just risking money, they're risking the entire narrative of who they are as a trader. When that trade fails, the psychological damage is enormous, not just the financial loss, the identity damage, the "how was I wrong about something I was so sure about" spiral. And this right here, is why smart traders blow up bigger than less experienced traders. Not because they take bigger risks out of ignorance, because they take bigger risks out of sophistication, out of a well-constructed, internally consistent, intellectually defensible certainty that the market ultimately doesn't care about. The fix is not to become less confident. The fix is to recognize that confidence in trading should never translate to increased position size. The only thing that should determine your position size is your risk management system, not your conviction level, not your analysis depth, not your certainty, your system. Because the market doesn't grade you on the quality of your reasoning, it only cares about what price does next. Point 4. The analysis paralysis loop. There's a moment every serious trader knows. You've done your analysis, you've found a setup, every condition on your checklist is met, the price is right where it needs to be, and then you wait. You want to check one more thing. You want to confirm on another time frame. You want to see what happens next. And then the entry passes, the move happens without you, and you watch it from the sidelines, frustrated, telling yourself you need to be more decisive next time. Then next time comes, and you force a trade that isn't there because you're overcompensating for the missed entry, and that one loses. This cycle, analysis leading to paralysis, followed by frustrated impulse trading, is one of the most common and most destructive patterns in intelligent traders, and understanding why it happens is the first step to breaking it. The root of analysis paralysis is actually very simple. It's the fear of being wrong. But in smart traders, this fear gets dressed up in intellectual clothing. It doesn't feel like fear. It feels like diligence. It feels like thoroughness. It feels like doing your job properly. I just want to be sure. But in trading, being sure is a lie you tell yourself. There is no sure. There is only probability. And every additional layer of analysis you add after a certain point isn't making you more certain, it's making your fear more sophisticated. Psychologists call this decision fatigue combined with uncertainty aversion. The more options and data points you have, the harder it becomes to commit. And intelligent traders have more options, more data points, more frameworks to consult. They read more books, follow more analysts, build more models, and each new piece of information adds another voice in the room. When it's time to pull the trigger, there are 20 voices, and they're not all saying the same thing. Meanwhile, a less analytical trader looks at the chart, sees the setup, clicks the button. They're in the trade. They have a stop, they have a target. They manage it. Not because they're better traders, but because they haven't built a committee in their head that needs unanimous consent before taking action. There's research from behavioral economics that's directly relevant here. Studies consistently show that beyond a certain threshold, more information doesn't improve decision quality, it degrades it. This is known as information overload, and in a domain like trading, where information is infinite and endlessly contradictory, the tendency of smart traders to absorb more of it doesn't give them an edge, it creates a fog. The traders who performed most consistently over the long term are not the ones with the most information. They are the ones with the clearest decision-making criteria. Simplicity with discipline beats complexity with hesitation every single time. And this is counterintuitive for smart people, because intelligent people associate sophistication with quality. The more complex the system, the more variables accounted for, the more intellectually rigorous it must be. But in trading, complexity is usually a defense mechanism. It's a way of feeling like you're doing everything you can to control an uncontrollable outcome. And the more complex your system becomes, the more exceptions it requires, the more judgment calls, the more moments where you need to override the rules, because this situation is slightly different from the conditions the rule was built for. And every override is a crack in your discipline. The best trading systems are usually simple enough to fit on a note card. Entry condition, stop loss level, target level, position size formula. That's it. The intelligence doesn't go into the system itself. The intelligence goes into the process of building, testing, and then trusting that system, and then keeping your hands off it. Point 5. The identity crisis that kills consistency. This is the one that nobody talks about, and it might be the most important point in this entire video. Smart people have strong identities built around their intelligence. From childhood, they received signals from parents, teachers, peers, institutions that their intelligence was their value. They were the kid who knew the answers. They were the one everyone looked to when things got complicated. Their intelligence wasn't just a trait, it was the story they told about who they were. And then they stepped into the markets, and the markets told them they were wrong. Repeatedly, indifferently, without explanation. For most people, a loss is a loss. It hurts financially, it's frustrating, but they move on. For intelligent traders, a significant loss carries a secondary wound. The loss doesn't just challenge their account, it challenges their identity. It asks an unbearable question. If I'm so smart, why am I losing? And that question is devastating, because the only answers available are deeply threatening. Either the markets are irrational and unfair, which protects the identity but destroys accountability, or I'm not as smart as I thought, which protects accountability but is psychologically intolerable. Most smart traders unconsciously choose the first answer. The market was manipulated, the algo ran my stop, the news was unexpected, the setup was technically perfect, the market just behaved irrationally. And maybe sometimes that's true, but when it becomes a default narrative, it's a psychological defense mechanism. It's identity protection masquerading as market analysis. This is called self-serving attribution bias, the tendency to attribute successes to personal factors, my skill, my analysis, my discipline, and to attribute failures to external factors, the market, manipulation, bad luck. Every human being has this bias to some degree. But in intelligent traders, it's amplified by how much of their self-worth is tied to being right. Because being right is how smart people prove their smartness, and being wrong, especially publicly, especially repeatedly, especially in an area they've invested enormous time and energy studying, is not just financially costly, it's existentially threatening. This is why intelligent traders often hold losing trades so much longer than they should. Cutting the loss isn't just a financial decision, it's an identity decision. It's saying, I was wrong, and every hour the trade stays open, there's still a chance it comes back. There's still a chance the narrative holds. There's still a chance the intelligence is vindicated. And this is also why intelligent traders often struggle to follow rules set by others. A less analytically inclined trader might just follow the system because they trust the person who built it. But a smart trader analyzes the system, finds the gaps, thinks of exceptions, starts second-guessing the logic, not out of malice, but because critical thinking is their natural mode. It's how they've operated their entire lives. Except that in trading, critical thinking in real time is almost always destructive. The time for critical thinking is before the trade, when you're building and testing your system, not during the trade, when every moment of doubt has a financial consequence. Here's what the most consistently profitable traders understand that smart traders often don't. Trading success is not an intellectual achievement, it's a behavioral achievement. You don't get paid for being right, you get paid for behaving correctly over a long series of trades. And behaving correctly means following your rules when it hurts, staying out of trades when nothing is there, cutting losses when your brain is screaming that the trade will come back, and sitting in profitable positions when every instinct tells you to take the money and get out. None of that requires intelligence. All of it requires discipline, emotional regulation, and identity flexibility. Identity flexibility, the ability to separate your self-worth from your trade outcomes. The ability to be wrong about a trade without being wrong as a person. The ability to lose without it meaning you're a loser. This is a psychological capacity, not an intellectual one, and it's arguably the most important skill in trading. And it's the one that intelligent people are often the least developed in because their entire lives have been built around always having the right answer. The way through, what consistently profitable traders do differently. Let me tell you what this actually looks like in practice, because I don't want to leave you with a list of problems without showing you the path forward. The traders who escape the intelligence trap share a few specific characteristics, and interestingly, almost none of them are about being smarter or knowing more. The first characteristic is radical process focus. Consistently profitable traders are obsessed with following their process correctly, not with whether individual trades make or lose money. They've internalized the understanding that in a probabilistic environment, any single trade outcome tells you almost nothing. What matters is executing correctly over a long series of trades. So they evaluate themselves on process, not outcome. Did I follow my entry rules? Did I honor my stop? Did I manage the position according to my plan? Those are the only questions that matter. This is a fundamental psychological shift for intelligent traders who are typically outcome-focused. They're used to being evaluated on results. They're used to the world rewarding correctness. But in trading, correctness of process and correctness of outcome are often disconnected in the short term, and accepting that disconnect, genuinely accepting it, not just intellectually acknowledging it, is one of the hardest things for a smart person to do. The second characteristic is emotional calibration, not emotional suppression, not the idea that you should feel nothing when you trade, but the ability to notice your emotional state without being driven by it. There's a significant difference between a trader who feels fear when a position moves against them and immediately acts on that fear, and a trader who feels the same fear, recognizes it, names it, and then executes their plan anyway. The experience is the same, the behavior is completely different. This is what emotional intelligence researchers call affect labeling. The simple act of naming an emotional state, I'm feeling fear right now, I'm feeling the urge to revenge trade, I'm feeling overconfident after this winning streak, activates the prefrontal cortex and reduces the emotional charge. It creates just enough space between stimulus and response to make a rational decision. Smart traders often resist this because acknowledging emotions feels like admitting weakness. It feels unscientific. It feels like it belongs in therapy, not in a trading session. But the research is unambiguous. Emotional awareness doesn't make you weaker as a trader. It makes you significantly stronger because you're no longer being controlled by processes you're refusing to acknowledge. The third characteristic is acceptance of uncertainty. Deep, structural acceptance, not just intellectual acknowledgement. Most intelligent traders understand cognitively that markets are uncertain. They can explain probability theory. They can discuss distribution of outcomes. They've read the books. They know the concepts. But when they're in a trade that's moving against them, the cognitive knowledge dissolves because cognitive knowledge and emotional acceptance are not the same thing. One lives in the thinking brain, the other has to be trained into the nervous system through repeated experience. The traders who have genuinely accepted uncertainty don't white-knuckle their stops. They don't check the screen every 30 seconds when they're in a position. They don't feel the need to constantly validate their thesis because they've genuinely accepted that they don't know what will happen next and that not knowing is completely okay. This acceptance usually comes after a specific kind of experience, not just losing money, but losing enough to have your intellectual defenses completely stripped away, losing enough that you no longer can build a narrative around it, losing enough that you're forced to confront the fundamental truth. The market does not care about you, your intelligence, your analysis, or your narrative. It just moves. That confrontation, as painful as it is often the beginning of real trading growth. The closing insight. Let me leave you with something that I think is the deepest truth in all of trading psychology. The traders who make it are not the ones who figure out the market. They are the ones who figure out themselves. The market is not a puzzle to be solved by the smartest mind. The market is a mirror. And every trading decision you make is a reflection not just of your analysis, but of your fears, your ego, your identity, your relationship with uncertainty, your emotional history with money, your need to be right, your capacity to sit with discomfort. The intelligence trap is ultimately a trap of identity. It's the trap of thinking that what makes you valuable in the rest of your life, your ability to analyze, to reason, to find the right answer, is what will make you successful in the markets. And the market teaches that lesson the hard way, over and over again, to brilliant people who refuse to hear it. Marcus, the trader I told you about at the beginning, eventually figured it out, not because he got smarter, he got simpler. He built a system with 3 rules, just 3. He wrote them on a card and put them next to his screen, and he made a commitment, not to his account balance, not to his win rate, but to following those 3 rules for an entire year without exception. The first 6 months were brutal. There were trades he missed because the rules said no. There were setups that looked perfect but failed one condition. There were moments where his analytical mind screamed that the rules were wrong and this time was different. He followed the rules anyway. In the second 6 months, something shifted, not in the market, in him. He started to feel less attached to individual trade outcomes. He started to experience the peace that comes from knowing that your only job is to execute the process. He stopped needing to be right. He started just needing to be consistent. And the results followed, not because he became a better analyst, but because he became a better self-manager. That's the real edge in trading. Not the system, not the strategy, not the indicators. You. The version of you that shows up on the good days and the bad days with the same level of discipline, the same emotional calibration, the same commitment to the process. You don't build that through reading more books. You build it through deliberate self-observation, through journaling every trade, not just for the outcome, but for the psychological state you were in when you made the decision. Through honest post-trade analysis that asks not was the market wrong, but was I following my rules? through building habits and routines that keep you mentally and emotionally stable before you ever open a chart, and through something that is genuinely hard for smart people, the humility to accept that in this domain, your intelligence needs to be a servant, not a leader. Your intelligence designs the system, your intelligence tests it, your intelligence refines it. But once you're in the market, your intelligence steps back, and your trained, disciplined, emotionally regulated self takes over. That's the shift. That's the transition from smart trader to profitable trader. And it's available to you right now, not after the next book, not after the next course, not after you figure out the next pattern. Now. The trap is always the same. The way out is always the same. Start with yourself. If this hit home for you, if you recognized yourself somewhere in this video, then do one thing before you close this tab. Not subscribe, not like, though those things help more than you know. Do this. Open your trading journal or a blank document and write down one honest answer to this question. In my last losing trade, was I following my rules or was I following my reasoning? That answer alone, if you're honest, will tell you more about your trading than any strategy video ever will. Thank you for watching. Stay consistent, stay humble, and see you in the next one.